The ticker tape flashes a live price anchor hovering right around $3.69, translating to a market capitalization sitting at roughly $3.55 billion. For the casual retail crowd scrolling through Robinhood or tracking chatter on Reddit and X, Opendoor Technologies, NYSE Open, is often dismissed as a volatile relic of the pandemic-era housing craze, a high-beta momentum play that soared past $10 and crashed back down to earth. Financial media channels love to paint it with a broad, lazy brush, a struggling iBuyer caught in the crosshairs of macroeconomic interest rate freezes and unpredictable residential real estate cycles. But if you pull back the layers of mainstream commentary, you uncover a massive blind spot. The market is pricing Opendoor as a traditional brick-and-mortar property flipper vulnerable to local housing downturns, completely missing the underlying structural reality. Opendoor is not a real estate agency. It is a high-frequency logistics and liquidity engine for the most illiquid asset class on Earth. Consider the physics of the housing market. Traditional real estate operates on an archaic, friction-laden protocol that has barely changed in a century. Buying or selling a home involves months of open houses, emotional negotiations, financing contingencies, title delays, and a grueling 60 to 90-day closing pipeline that traps trillions of dollars in stagnant home equity. Retail investors looking at quarterly housing starts or mortgage rate ticks miss the core operational engineering that Opendoor has quietly built. The company uses advanced predictive pricing algorithms, localized liquidity models, and instant offer machinery to turn residential real estate into a fungible, tradable digital asset class. While the public focuses on whether mortgage rates are dropping by a quarter point, institutional operators look at inventory velocity, spread compression, and the proprietary data moat formed by processing hundreds of thousands of home valuations across dozens of regional markets. This creates a fascinating psychological divergence between public perception and institutional reality. On social trading apps, retail investors view a stock like Open through the lens of short-term sentiment swings, panicking during a housing market headline dip or chasing momentum during a speculative breakout. Meanwhile, sophisticated market participants are analyzing the structural compression of transaction costs and the scalability of a digital marketplace that bypasses traditional brokerages entirely. The mispricing stems from a fundamental failure to understand that Opendoor's software-enabled inventory turnover is fundamentally different from holding physical property. When you evaluate Opendoor as a software-enabled market maker rather than a conventional house flipper, the entire risk-reward profile flips on its head. Take a look under the hood of daily trading activity and you will see why Opendoor remains one of the most intensely contested battlegrounds in the small-cap growth universe. With average daily volumes regularly swelling past 50 million shares and periodic spikes crossing 171 million shares during major corporate updates or macro catalysts, Open exhibits the classic footprint of a high-volatility retail favorite married to heavy institutional accumulation. Macro jitters, driven by fluctuating Federal Reserve rate trajectories, inflation prints, and regional banking anxieties, frequently trigger sharp sell-offs. During these pullbacks, retail traders are routinely shaken out by automated stop losses and sensationalized media reports declaring the death of iBuying. Yet, beneath these turbulent surface waves, a very different story unfolds in the institutional order books. When weak hands capitulate during macro-driven dips, long-term institutional heavyweights and specialized small-cap growth funds quietly absorb shares, positioning themselves for multi-quarter inventory expansion. Recent corporate developments underscore this dynamic vividly. Opendoor executed its first-ever share buyback, successfully reducing its total shares outstanding by 5%, while simultaneously securing $440 million of fresh growth capital at 0% coupon. In the current macro environment, raising nearly $500 million at zero cost while simultaneously retiring equity is a masterclass in balance sheet engineering. It signals that sophisticated capital providers are willing to back the platform's long-term liquidity vision with real skin in the game. This brings us to a crucial checkpoint for you, the market participant. As you watch Open navigate these choppy waters between its 52-week low of $2.26 and its high of $10.87, how are you playing the tape? Are you actively accumulating shares during these macro-induced liquidity troughs, or are you sitting on the sidelines waiting for structural confirmation before stepping into the arena? Drop your thoughts in the comments below. Let's see how many of you are tracking the institutional accumulation patterns versus trading the emotional noise. To truly understand where Opendoor is heading, we have to strip away the outdated historical framing that haunts the company. When Opendoor burst onto the scene in 2014 under visionary founders including Eric Wu and Keith Rabois, it was labeled as a tech-enabled house flipper. Wall Street tried to value it like a traditional home builder or a cyclical real estate brokerage, applying rigid price-to-earnings and asset-heavy multiples that made zero sense for a marketplace model. The catastrophic housing market freeze of 2022, marked by soaring interest rates and sudden home price corrections, forced the company to take heavy inventory write-downs, validate its risk models the hard way, and undergo a brutal operational restructuring under leadership like CEO Kerry Wheeler and later Khosra Nagiati. That painful baptism by fire transformed Opendoor from an aggressive, growth-at-all-costs startup into a lean, software-driven digital infrastructure provider. Today, the company's core operational segments go beyond simply buying a house and reselling it. Opendoor operates an integrated e-commerce ecosystem that spans instant cash offer generation, digital title insurance, escrow services, settlement coordination, and flexible financing options. Instead of relying on manual appraisals and local human bias, the platform relies on automated valuation models, or AVMs, that ingest localized pricing data, historical transaction speeds, school districts, and macro housing inventory metrics in real time. The outdated narrative views Opendoor as a victim of housing market volatility. The modern reality is that Opendoor acts as a market maker, charging a transaction fee or service charge for providing instant liquidity to homeowners who value certainty, speed, and convenience over the traditional agonizing 6-month listing process. By standardizing the home sale transaction into a streamlined digital checkout flow, Opendoor captures revenue not just from the spread on property resale, but from an entire sticky web of ancillary services like title, escrow, and mortgage origination. This shift from a capital-intensive property speculator to an asset-light transaction platform is the exact evolution that short-sighted bears completely fail to model. Looking out across the multi-year horizon, Opendoor's growth catalysts are deeply tied to the inevitable digital transformation of the trillion-dollar residential real estate sector. As younger demographics, millennials, and Gen Z who expect every single transaction in their life to happen instantly via a mobile application become the dominant cohort of home buyers and sellers, the friction of traditional real estate will become increasingly intolerable. Opendoor's strategic positioning as the undisputed technological gatekeeper of digital iBuying gives it a massive first-mover advantage. Furthermore, as the macroeconomic cycle normalizes and interest rate stabilization eventually unlocks pent-up home inventory, transaction velocity across the United States will rebound aggressively, directly supercharging Opendoor's top-line revenue growth and margin expansion. However, an objective financial analyst must weigh these massive catalysts against very real structural risks. Real estate remains fundamentally cyclical and hyperlocal. Unforeseen macroeconomic shocks, persistent inflation spikes, or sudden surges in mortgage rates can freeze housing turnover, risking asset depreciation. Additionally, execution risk remains high. Maintaining tight discipline on pricing models to prevent overpaying for homes during market inflections is an ongoing algorithmic challenge. Ultimately, looking past the short-term price noise of daily stock fluctuations is essential for any serious investor evaluating Opendoor. The market often oscillates wildly between overestimating near-term cyclical headwinds and underestimating the long-term compounding power of a monopoly-style marketplace. If Opendoor continues to refine its automated risk models, expand its service footprint across national markets, and consolidate its position as the default digital off-ramp for homeowners, today's depressed valuations will look like a historic mispricing. In the grand arc of market history, true wealth is generated not by